It's Bradley here with Freedom Finances, and today I just wanted to go over some of the news that came out yesterday, starting with the GDP results for quarter two, and then going over the Federal Reserve and their decision on interest rates and why it really matters, and if it matters to your personal finances and what the forecast for the economy is in the future. So let's go ahead and start off with the GDP for Q2 of 2025. The real GDP increased 3% for the quarter, which is a very good number. It's a lot of growth. It's strong, especially after the GDP retracted in quarter one. Now, if you really break down what's happening over the last couple quarters, it really comes down to imports and exports. And we've heard a lot about imports when it comes to tariffs, when it comes to all these things about importing things and how it helps or hurts our GDP. In Q1, essentially what happened was all these businesses were afraid of all the tariffs that were going to happen starting in April potentially. So what they did is they brought in a bunch of their stuff overseas that they were selling for dirt cheap or making for dirt cheap. They brought it into the United States. They shipped it into the United States. They purchased it to avoid tariffs. Now, what happens is when the import rate is really high, it's actually a negative to our GDP. So GDP is calculated based on consumer spending, which is stuff we buy, people like you and me. It's also based on investments, which is the business side. So what companies spend. It's also based on the government spending. So how much do the government spend on employees or contracts, what have you? Those are all positives to the GDP. So the more spending, the better is kind of the idea. Exports are a positive thing and imports are a negative thing. So if you export, which means you sell more to different countries, less than you import, that's a negative and it brings the GDP down. So that's essentially what happened last quarter is we imported more than we spent here in the United States. It plummeted our GDP for quarter one. Now, quarter two is a little funny because it was quite the opposite. We dropped a lot of our imports. So let me read the report from the Bureau of Economic Analysis. Compared to the first quarter, the upturn in real GDP in the second quarter primarily reflected a downturn in imports and an acceleration in consumer spending that were partially offset by a downturn in investment. So what that means essentially is we stopped importing so much and consumers started spending a lot. Consumers started spending more because prices were kind of getting more even, especially energy prices got better late quarter two, early quarter two. Egg prices got better, so we started spending a lot more as consumers. However, investment spending, which is what businesses do, they've been very cautious. A lot of it comes down to the tariffs and they're worried about really making big investments, which for the economy isn't necessarily a good thing. I know that we always give businesses hard time for making a lot of money, but we want them to spend, right? We want them to employ us to spend money to get things flowing in the economy. So essentially what it's saying is consumers spent a lot, we imported less, but businesses were very cautious. They actually spent less. The idea of the tariffs is let's make it easier to make stuff and hire workers in the United States and ship them out to other countries where right now we buy a lot of stuff from overseas, whether it's cheap plastics or fabrics, even expensive things. This is a talking point that's been really poor, is that we only make good, high quality, expensive stuff in the United States. We buy the cheap stuff from across the sea. That's not true. We buy a lot of our expensive electronics from Asian companies, whether it's South Korea, Japan, China, Taiwan. We buy a lot of that stuff from other countries. We don't necessarily not make anything here, but we spend a lot of money importing stuff. So that's the idea, is Donald Trump wants to make things in the United States. We'll see if that works out, and we'll talk about inflation here in a little bit. But let's go to the Federal Reserve's decision. A lot of people thought that the Federal Reserve was going to hold steady on the interest rates, and that's exactly what they did. So let's go ahead and read some of this stuff. Although swings in net exports continue to affect the data, recent indicators suggest that the growth of economic activity moderated in the first half of the year. The unemployment rate remains low and labor market conditions remain solid. Inflation remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate. All right, so essentially what they go on to say is next that the committee has decided to maintain federal funds rate at 4.25 to 4.5%. Inflation is still a little higher than they want, and employment is strong, so they don't have an incentive to decrease the interest rate. So it's really important to understand why they would decrease the interest rates. The lower the interest rates, the more people can spend, essentially. The more people can buy, the more people can borrow. The more you borrow, the more you spend. That means demand is going up. As demand is going up, usually more people get employed. More businesses spend money. So this is kind of where the economic data from Q2 comes in, is like businesses aren't necessarily spending much right now. So the Federal Reserve is kind of keeping an eye on that. They don't necessarily care about the GDP. They just care about unemployment and inflation. So if unemployment goes up, if businesses stop spending and stop hiring, and we'll look at some data here, if they stop doing that, then they might drop interest rates to make people want to spend more money, hire more people. However, as inflation goes up, that means people are spending a lot, demand is up, prices are up, so they want to increase interest rates so that way inflation slows down. Now, they're saying inflation is a little bit elevated and it's a little bit higher than the 2%. But here's the funny thing, it's way down from where it was at the 6, 7, 8, 9% in 2022. So it's way down, but they don't want to mess with things. They're just essentially being overly cautious at this point. So they're like, we're not going to do anything. Things are looking good. Essentially, the two factors, unemployment and inflation, they're fine. All right, so let's take a look at how this impacts regular people and personal finances. Now, the interest rates don't necessarily correlate to mortgage interest rates directly. However, as interest rates go down from the federal funds rate, usually the mortgage rates kind of follow suit a little bit as interest rates are just generally lower. So right now, today, July 31st, the mortgage rate from Freddie Mac came out. For a 30-year mortgage, it's at 6.72%. So about 2.5 points higher than the federal funds rate. Mortgage rates are still high, which means your interest payments are still high in your mortgage, which means people aren't very encouraged to buy homes. Now, home prices are at an all-time high. I kind of hate that talking point because they're usually at an all-time high. They always go up. Sometimes it's slower, sometimes they go down a little, but then they go up and it's at an all-time high. They always get more expensive. I think the idea is let's say this interest rate went from 6.72 to 4 for mortgage rates. What would happen? More people would buy homes. Demand would explode. What would happen if everyone wants to buy a home? Well, then the suppliers, which are those who are selling their homes, would be like, hey, there's a bidding war. Prices are going up. So that's essentially what the Federal Reserve is looking to avoid, is prices skyrocketing. Is it a good benefit to keep prices low so that way we don't have inflation? What can we do with that? If we can't spend our money because everything's too expensive from just interest, does it really matter? Do I want to have a more expensive house with a lower interest rate or a cheaper house with a higher interest rate? Which one would you prefer? It's hard to say. So at this point, it really comes down to job data, which is really what matters. Inflation is important, don't get me wrong, especially when they skyrocket, they spike, but jobs is what matters most. So you may hear that 2% inflation is healthy, and in a sense it is, because you want your stuff to go up in value, right? You want your home to slowly increase in value. So let's look at some data. Right now, the unemployment rate is 4.1%. That's pretty good. It would be amazing if it's under 4, but 4.1% means at or near maximum employment. Compensation, we've also seen that wages have outpaced inflation. So you're getting paid more than inflation is going up. That's a very, very positive thing. So in theory, if inflation is always up 2%, but you always get paid more than 2%, that's good. You're making more money than the cost of living. In general, the economy, the wages are better than inflation. So there have been a couple news releases which just make me feel slightly uncomfortable about jobs going forward. So first, the unemployment cost index, which isn't necessarily a bad thing. Compensation costs for civilian workers increased 0.9%, seasonally adjusted for the 3-month period ending in June 2025. The U.S. Bureau of Labor Statistics reported that wages and salaries increased 1% and benefits cost up 0.7%. Essentially, it's getting a little more expensive to hire people, which in theory is a good thing, right? It's good that we cost money. Our demand as workers is high. If businesses are making less money, they're gonna hire less. All right, let's look at the metropolitan area employment and unemployment summary. This is for June 2025. Unemployment rates were higher in June than a year earlier in 217 of the 387 metropolitan areas, lower in 147 areas, and unchanged in 23 areas. And here's the last thing, because it's slight. I've always thought that 4.1% to 4.2% is good. We don't want to go over that. I would love to see it at 3.9 or less. Last thing, job openings and labor turnover summary from the 29th. The number of job openings was little changed at 7.4 million in June. The U.S. Labor Bureau of Statistics reported that over the month, both hires and separations were little changed at 5.2 million and 5.1 million, respectively. Couple this data, we go back to Q2 consumer spending up, good. Business spending down. It kind of reflects that businesses are tightening up a little bit, whether it's tariffs or whatever else. And Jerome Powell actually said it's not just tariffs, but a little bit of inflation outside of tariffs is causing some issues. Overall, what does this mean? It probably means that if we get another report, let's say for a month or two, that says unemployment is going up, then we need to lower interest rates. If in the end unemployment stays at 4.1%, but inflation goes up, they're not going to do anything. Spending is fine. Now, Q2 GDP was a good thing. It showed the economy grew and consumers started spending, but a lot of that growth came from less imports. So it's kind of confusing how the calculation is. We imported less in Q2 than we did Q1. So in theory, our GDP went up. And it's kind of a red herring in a sense, because our spending, businesses are spending less, we just imported less. We're spending less also on importing stuff from other countries. All right, that's about it for today. Right now, my thoughts are the federal rates fund, it's not changing much. I think if we see some bad employment information, which we might see it tick up a little bit, unemployment, then I think we'll see the interest rates go down. If everything stays the same with employment and inflation ticks up a little bit, they're definitely not going to lower it. There's really no reason to if the economy is really strong, but inflation is going up a tick while the job market is staying the same. All right, thanks for watching, and keep following for more finance news and finance tips.